For much of the past 2 years, all of Southern California has lagged behind the national pace of recovery for the apartment market. But in recent months, Los Angeles and Orange County have started to show some impressive gains. So what about San Diego? We'll take a look. Welcome to Apartment Market Dynamics from MPF Research. I'm Jay Parsons with your San Diego update. Southern California markets are accustomed to outperforming the U.S. norms for apartment revenue growth, but that wasn't happening in 2010 or the first half of 2011. Now, that did change in third quarter when Los Angeles and Orange County broke ahead of the pack with some good demand and strong rent growth numbers in third quarter. But we're not seeing that in San Diego. It's really been the same story, strong occupancy rates, but mediocre rent growth levels. Let's take a look at the numbers, starting with occupancy. And as you can see, we had a big quarter in San Diego, occupancy up 1 point to 96.8%. And this was significant because prior to that point, occupancy had been pretty stagnant over the previous 6 quarters. So strong demand in third quarter, at the same time new supply levels remain minimal. And that puts San Diego on top of all SoCal markets for occupancy. Los Angeles and Ventura Oxnard are closest at 96.4%, and Orange County is at 95.7%, and in the Inland Empire trails 94.7%. But despite that strong occupancy rate, we have yet to see much rent growth in San Diego. Take a look at this chart comparing annual rent growth in San Diego versus the U.S. norms, and this shows you a few things. Number one, that rent growth was a bit better in San Diego compared to the U.S. prior to the recession. Number two, San Diego didn't cut rents much during the downturn. In fact, the cuts here were a little less significant than they were for the U.S. overall, and a lot less significant compared to other Southern California markets. And number three, San Diego has consistently trailed the pace of recovery since the market turn in 2010. You see the rent growth levels just well below those U.S. averages. Same-store rents up just 2.8% year over year as of third quarter. So here's where Los Angeles and Orange County are standing out. Rent growth of 4.8% in L.A., 4.3% in the OC, but much weaker in San Diego, the Inland Empire, and Ventura Oxnard, all between 2 and 3%. However, and this is a very big however, when we look further back in the bigger picture, San Diego is actually looking pretty good. Compared to 4Q 2007 levels, same-store rents in San Diego are up 2.8%. And by that measure, every other Southern California market is still in negative territory. As you can see, still down 3 to 6%. And again, that's because during the recession, San Diego just didn't cut rents nearly as significantly, and that has helped the overall numbers look a little better. Now let's wrap it up with a submarket highlight for you. Rent growth levels have been mild to moderate pretty much across the board, but there is one notable exception. Santee, Lakeside, Poway, same-store rents up 6.7% year over year as of third quarter, and occupancy there is at 97.4%, up 0.9% annually. And looking ahead, we think occupancy in San Diego is going to get it back above 97% in 2012, but rent growth levels should remain pretty moderate, probably just under 4% over the next 12 months. And that's because, number one, operators here tend to be more conservative than in other markets when setting prices, and number two, we still have some economic concerns here in Southern California. And that wraps us up for San Diego, so until next time for Apartment Market Dynamics and MPF Research, I'm Jay Parsons. Thank you for watching.
Want more? Go deeper with NPF Research's apartment market reports. From a national level, down to individual metros, to specific neighborhoods, NPF Research has been providing unparalleled apartment market intelligence to the multifamily industry for almost 5 decades. Learn more by contacting us at 877-284-4938 or visit www.npfresearch.com and click on Market Reports.